Remen Flyers, my friend. Remen Flyers. You brand them, you take them to real estate offices, you tell them you could do a fantastic job, you get business out of it, everyone's happy. All you gotta do is sign up with Remen. What are you really doing today on this Monday? What are you doing? Are you sitting at your desk right now, or are you out talking to agents like you should? Click this banner right over there. Okay, today we are going to be talking about the exciting world of loan servicing. Woo! Loan servicing! Yeah! This is awesome! This is a good show, guys. According to the Mortgage Bankers Association, the cost to service a performing loan was $181 in 2015. Now, servicing a loan is not just the cost charged to collect the principal and interest and escrow payments from the borrower. It's also to send money collected to the note holder, providing statements, tax reporting, informing the homeowner if the note is sold, amongst other things. So for all of that, $181 seems pretty good to me.
Now, would you change your mind if you knew that the same service provided just 7 years earlier was only $59? In other words, the cost tripled over the course of 7 years. Though $181 doesn't seem like a lot of money for the job provided, 3 times more of anything over that period of time, it's a big deal. For example, the average price of gas back in 2008, at that particular time, was $4.11 per gallon. That'd be like gas going to $12 a gallon. The thing is, if you're buying 1 gallon of gas or servicing one loan, no big deal. But when you're filling up once a week, or you're servicing thousands of loans, we start to take a closer look, right? Either way, who cares? The loans are performing, so everyone's happy, screw the price. But what about when the loans don't perform?
Stick with us, guys. A non-performing loan is defined as a loan that is not performing. You understand, right? No payments are being made. So how much does that cost? To service a non-performing loan, a loan that does not perform, anybody? Anybody?
Well, according to the MBA, in 2015, for one loan, $2,386.
So that means when a loan quits performing, that loan just got 13 times more expensive to deal with in 2015. This is real money, a real cost. When things go wrong, they go wrong. So we're going somewhere with this. Now, I think it's going to trip you out.
Haven't touched any more of that acid, that's for sure.
Okay, so in 2015, when a loan goes from performing to non-performing, 13 times more expensive at $2,386 per loan. Got it? Okay, back to 2008. What was the cost when a loan back then went from performing to non-performing?
Only $482. A loan now, $2,386 when a loan busts. Back in 2008, when every bank had a bailout, it was only $482.
So in 2008, the cost from performing to non-performing goes up 8 times, but the cost on a per loan basis was only $482. So what we can deduce is that a non-performing loan is bad. Bad back then, and of course, bad now. But that only spells part of it.
The cost of a non-performing loan from 2008 to 2015 is a whopping 5 times more expensive. So not only has the year-over servicing cost for performing and non-performing loans beat inflation and beat it bad, but the cost at 5 times more expensive from performing to non-performing over that period of time has absolutely skyrocketed. Now, this should concern you.
If in part we had the last recession and massive bailouts for banks based on the cost of defunct loans, non-performing loans at a price of $482 in 2008, the very year that it happened, what then happens to the banks and our overall economy if those very loans were to bust again? But this time, the cost is a full 5 times more expensive. Could we not then assume that a recession, if not 5 times worse, would certainly be much, much worse, right? I think the only conclusion that you can draw is yes. Now, time for a dramatic moment of pause to let this all sink in. Okay, enough of that. So why is it more expensive to service a loan now?
Additional costs in collections, loss mitigation, foreclosure, post-sales, unreimbursed foreclosures and real estate owned losses, new and fancy default specialists, they're not cheap, technology, accounting, time to foreclose, and the byproduct of policies from state attorneys general and other government regulatory agencies.
So if that's the case, if we accept that a next recession would be worse because the costs are measurably higher now than then, and that these costs are byproducts of policies and enforcement, then 1. Should we have made these changes? 2. Would we hold the states and agencies responsible for this oversight? And 3. Should not any further compliance and regulatory changes mandated by these agencies now begin with shrinking the costs associated with defunct or non-performing loans? And you thought a conversation about mortgage loan servicing was gonna be a party.
So you get it, with all the compliance we have, the cost for non-performing has increased, far outpacing any type of inflation, to where if they were to all fall at the same time, the cost would be measurably higher than it was back in 2008, which would make a recession that much worse, right?
Right.
So if these are the byproducts of our policies, then maybe the policymakers and all the changes are actually or potentially could disproportionately hurt us even more the next time around.
Yeah, that's a good point, man. Let us know your thoughts down below. Put your comments down there, forward share, and subscribe for free in your upper right-hand corner. Catch you later here, the National Real Estate Post.
Bye.